Welcome to your study guide for the New York Property and Casualty exam. These are the building blocks every other topic is built on. In this video, we'll cover risk, hazards, handling risk, insurable risk, insurers, agency. And don't forget, our website is packed with free study guides and practice questions designed to help you pass with confidence. You'll find the link right in the description below, so go ahead and grab those resources. Study smarter, not harder, and you'll be ready in no time. Alright, let's dive in. So, what is insurance? It is a contract that transfers the risk of financial loss from a person or business onto an insurer in exchange for a premium. You cannot predict whether you will suffer a fire or a crash, and the cost could be ruinous. Insurance moves that uncertain cost onto the insurer. Think about what you are trading. You hand over a small certain cost, the premium, and shed a large, uncertain loss. Over a lifetime, most people pay more in premiums than they collect, yet coverage stays rational. Why? People are risk averse. The dread of one unaffordable catastrophe outweighs many small premiums. Now, keep the players straight, because the exam loves this. The first party is the insured, who buys protection. The second party is the insurer, who promises to pay. A third party is someone outside the contract who may still bring a claim, usually a member of the public your insured injures and who sues. This is why liability coverage is called third-party coverage, while coverage that pays your own losses is first-party coverage. Here is the trap to dodge. The agent is never a party to the contract. The agent only arranges it. So if a question asks who the first party is, the answer is the insured. Let us build the core vocabulary, because 5 terms anchor this domain. Start with risk. The uncertainty that a loss will occur. Every drive to work carries a chance, never a certainty of an accident. And that uncertainty is risk. Risk comes in 2 flavors, and only one of them can ever be insured. Pure risk means only the possibility of loss, with no chance of gain. Your house either burns or it does not, and that risk is insurable. Speculative risk carries the chance of a loss or a gain, like gambling, investing, or a business. Because you could come out ahead, insurers will not touch it. Picture 2 business owners. The first worries her warehouse might burn. That is pure risk. The fire either happens or not, and she gains nothing if it does. The second worries her product might flop, though it could make her wealthy. That is speculative, her own bet. Only the first is insurable. Exposure is next. The condition of being subject to possible loss. The situations an insurer could be liable for. The more exposed you are, the likelier a loss. A salesperson driving all day has far greater auto exposure than one phoning the same clients. Underwriters rate exposure, and more exposure means a higher premium. A hazard is anything that increases the chance or severity of a loss. It does not cause the loss, it stacks the deck. There are 3 types, and you must know all 3. A physical hazard is a tangible condition you can point at. Bald tires, a dead tree leaning at the house, faulty wiring. The other 2 hazards sound identical, and the exam exploits that. A moral hazard springs from dishonesty, someone who would lie on an application or fake a loss to collect. A moral hazard springs from carelessness, the "I am insured anyway" attitude. Faking a theft is moral. Leaving your car running and unlocked is moral. Peril is simple after those hazards. A peril is the cause of a loss, what happened to produce the damage. If the house burns, the peril is fire. If lightning fries the electronics, the peril is lightning. Hail, theft, and flood are perils. The hazard is whatever made that cause more likely. Loss is our 5th term, and it splits in 2. A direct loss is physical damage with nothing between the peril and the harm, like lightning striking a roof. An indirect loss, also called consequential, flows from that direct loss. After a restaurant fire, the charred ovens are direct. The months of lost profit are indirect. Here is where I would slow down, because students hand away easy points. Strip away the fire and the lost rent, and profit vanish, which makes them consequential. The physical damage is direct. The dollars lost because of it are indirect. This is why a business needs business income coverage, not just coverage on the building. What we just covered, hazard versus peril, direct versus indirect, is exactly what those free practice questions drill into you. They are not surface level. They test the deep understanding the real New York exam demands, where 2 answers look right and only one is. Go try a handful once we finish here. Wamid. Insurance is only one of 5 ways to handle risk, and the hook is STAR. The first letter is sharing, where a group splits one another's losses, like stockholders absorbing a company's risk. The second is transfer, which is insurance itself. When a scenario says someone bought a policy, the method is transfer. Avoidance is the A, the only method that drops your chance of loss to 0. You never do the risky thing, never drive, never own the pool. The first R is retention, where you keep the risk and pay losses yourself. Going without coverage is retention, and so is accepting a deductible. Retention wears 2 faces. Active retention is a deliberate choice to keep a risk because it is small or cheaper to absorb than to insure, like a company funding a reserve for minor losses. Passive retention is keeping a risk you never noticed. A deductible is the everyday example. You actively retain that first slice. The final R is reduction, lessening how often a loss happens or how severe it is without erasing the risk. Sprinklers, smoke detectors, deadbolts and seat belts are all reduction. Here is the clean way to keep 3 apart. Never driving is avoidance. Wearing a seatbelt is reduction. Cancelling your policy is retention. Not every pure risk can be insured, and the test is CANHAM. The C is calculable. The odds and cost must be predictable from past data, so a fair premium can be set. The A is affordable. The premium must be something an average person could pay, which works best for losses that are serious yet rare. The N is the one examiners adore. The risk must be non-catastrophic to the insurer, not the kind that strikes thousands at once. That is why war is excluded and floods need special coverage. The H is homogeneous, many similar units, so losses stay predictable. An actuary would never blend brick houses with wood frame. The second A is accidental. The loss must happen by chance, which is why no policy pays the person who burns down their own home. The M is measurable, definite and fixed in time, place, and dollars. Watch for the trap. An except question dangles catastrophic. It must be non-catastrophic, so catastrophic is your answer. I know we are stacking up definitions, and you might wonder how to keep them straight under pressure. That is why I built those free practice questions. They mix these concepts the way the test does, so you choose between the STAR methods and the CANHAM elements in one question. The link is below. Adverse selection is a tendency you must name on sight. It is the pull that draws higher than average risks to seek out insurance and cling to it harder than ordinary people. The person in poor health, the reckless driver, the owner of a fire-prone building, each is who an insurer would rather avoid. Why is that dangerous? Premiums are priced assuming an average pool. Let it fill with bad risks and claims blow past predictions. The insurer's defense is underwriting, the screening of every applicant. When underwriting finds a worse than average risk, the insurer can charge a higher rate, limit the coverage, or decline the application. Let me show how ugly adverse selection gets unchecked. Suppose the only people buying flood coverage are those whose homes flood every spring. The insurer collects average premiums but pays the worst claims. Losses outrun premiums. Rates climb, the good risks leave, and the pool worsens. That spiral is what underwriting exists to stop. The law of large numbers is the engine underneath all of this. The more similar units you observe, the more accurately you predict future losses. Flip a coin once and you know nothing. Flip it 10,000 times and you can call almost exactly half heads. Across 1 million homes, an insurer predicts the fires well. Notice how this loops back to homogeneous from CANHAM. The prediction only holds if the units resemble one another, so a few odd losses cannot throw it off. This, in my view, is the most important idea in the domain. It explains why pooling works and why insurers chase large volumes of similar business. Reinsurance is insurance for insurers. When a company wants to shed some of the loss it could face, it pays a premium to a second company to take on part of that risk. Learn the two names. The ceding insurer gives the risk away. The reinsurer accepts it for a share of the premium. There are two ways to arrange reinsurance, and the exam wants the difference. Facultative reinsurance reviews each risk individually. The reinsurer can accept or reject, case by case, which suits one unusual exposure. Treaty reinsurance automatically accepts a whole class of business with no case-by-case review. Faculty means option, so facultative is the picky one. If reinsurance or adverse selection felt slippery, do not sweat it. That is normal, and it is why that free question bank exists. Working real problems turns a fuzzy definition into something you recognize instantly on test day. Those questions cost nothing. They are linked below and they were built for this New York exam. Now we shift to the companies, starting with who owns them. A stock insurer is a corporation owned by its stockholders who elect the board and collect profit as dividends. 3 facts get tested. Those dividends go to stockholders, not policyholders. They are taxable, a share of profit, and they are never guaranteed. Because policyholders of a stock company do not share in profit, its policies are non-participating or non-par. Think of it plainly. A customer at a hardware store gets no slice of the store's profit, and neither does the customer of a stock insurer. The investors put up the capital, so the investors collect the rewards. A mutual insurer flips that ownership. There is no stock and no stockholders. The policyholders own the company, elect its board, and receive leftover funds as dividends. Here is the contrast examiners love. A mutual's dividend is not taxable because the law treats it as a refund of overpaid premium, not profit. Since the owners share in the results, a mutual issues participating or par policies. Lock in the mirror image. Stock means taxable dividends and non-par policies. Mutual means tax-free dividends and par policies. One more term. Demutualization, when a mutual converts into a stock company. The reverse is called mutualization. A fraternal benefit society is a different animal. It exists for its members and offers insurance as one perk of belonging, organized around a shared religion or ethnic bond and a lodge system. You must be a member to buy it. Its policies are certificates, and members can be assessed extra if claims outrun premiums. A few other forms show up. A reciprocal is an unincorporated group of subscribers who insure one another, run by an attorney in fact, and that attorney in fact is the giveaway on the exam. Lloyd's of London is not a company, but a marketplace, where individual underwriters take on risk and are individually liable. 2 more grouped forms trip people up. A risk retention group is itself an insurer, formed by members of one industry to provide their own liability coverage. A risk purchasing group is not an insurer. It merely buys coverage for its members. The retention group retains risk, the purchasing group only purchases. Some risks are too big or too public for private insurers, so the government steps in. The federal government covers war risk, nuclear energy liability, flood through the national program, and crop insurance. The state level handles unemployment insurance and workers' compensation. The catastrophic perils private insurers avoid are the ones Washington picks up. A company needs a license, called a certificate of authority, before it can sell in a state. With it, the insurer is admitted or authorized. Without it, the insurer is non-admitted or unauthorized and writes surplus lines. Only admitted insurers belong to the State Guarantor Fund, which pays covered claims if an admitted carrier fails. Surplus lines exist for the hard-to-place risk, the casino, the mine, the skyscraper no admitted insurer will write. It goes through a licensed surplus lines broker, and the carrier usually sits on the state's approved list. One rule the exam insists on: never buy surplus lines just to chase a cheaper price. Quick reminder while we are between insurer concepts. Everything we are sorting out now, admitted versus non-admitted, the company forms, the classification, shows up constantly in that free question bank. Reading these once is not enough. You have to retrieve them. Pull up a few questions and let them tell you which labels still slip. 3 more labels describe where a company was born. Domestic means it operates in the state where it was chartered, so a company formed in New York is domestic here. Foreign means chartered in another United States state like New Jersey. Alien means chartered in another country like Canada. Foreign is out of state, alien is out of the country. Here is the subtlety I would underline twice. Where a company was chartered and whether it is licensed are separate questions. A foreign insurer from Connecticut becomes admitted in New York once it earns a New York certificate of authority. And most insurers New Yorkers buy from are exactly that, foreign but admitted. Insurers also get graded on financial strength by independent rating agencies, names like AM Best, Standard & Poor's, Moody's, Fitch, and Weiss. They weigh loss experience, reserves, investments, management, and expenses, then issue a report card on the ability to pay claims. AM Best is most tied to insurance. The number of clients never counts. Finally, insurers reach you through distribution systems, and one trap is worth flagging. Independent agents sell for several insurers and own their renewals. Captive agents represent one company which owns the renewals. Direct writers sell through employees. Do not confuse a direct writer who uses a producer with direct response, where there is no agent at all. We are deep in insurer types now, and this is where repetition pays off. Mastering these labels takes practice, and the free questions linked below turn what you are learning this minute into automatic recall. Take what we cover and immediately test yourself. That loop is how this knowledge becomes exam ready. The last big idea is the law of agency, which governs how a producer acts for an insurer. In any agency relationship, the principal is represented and the agent is authorized to act. The fact that drives everything. In insurance, the insurer is the principal and the producer is the agent, even while facing the customer. Because the producer is the insurer's legal agent, the law treats the agent's words and conduct as the insurer's own. A premium paid to the agent counts as paid to the insurer, even if the agent never forwards it. A fact the agent learns is treated as known by the insurer. This underpins waiver and estoppel. An agent can only bind the company as far as their authority reaches, and there are 3 kinds. Express authority is written explicitly into the agency contract, the list of what the agent may do. If the contract authorizes policies up to $500,000, that is the express limit. Binding authority is a common example. Implied authority is never written down, yet it must exist for the job to function. It is presumed because it is necessary to carry out the express powers, the ordinary acts a producer performs. The contract never says the agent may print logo business cards or rent an office, but that authority is implied. Apparent authority is the slippery one, and it lives in the mind of the public. It is the authority an agent appears to have from how things look, even when the insurer never granted it. The company's sign hangs in the window. The agent takes its applications, so a reasonable customer assumes the agent can act. Let me make that concrete, because it is heavily tested. An agent emails a customer that the policy covers flooding, when it actually excludes flooding. Because the customer reasonably relied on that apparent authority, the insurer may be forced to pay anyway. This is the bridge to estoppel. The company is stopped from denying it. Picture an agent named Dana to tie the three together. Her contract lets her bind homeowners coverage up to a set limit on standard houses. She tells a caller, "You are bound today." That is express authority. She emails a confirmation on letterhead, implied authority. Then she binds an unusual log cabin, where apparent authority may bind the company. An agent handles other people's money and advises on big decisions, so the law imposes a fiduciary duty, a duty of trust owed to applicants, insureds, and the insurer alike. Every premium collected is trust money. The agent must also know the products well enough to explain them and make suitable recommendations. The sharpest fiduciary rule is the ban on commingling, mixing clients or the insurer's funds with the agent's own. It is illegal even if the agent never steals a cent, because once the money is blended, you cannot tell whose is whose. Premiums belong in a separate trust account. Spending them personally is theft, called conversion. As we move toward wrapping up, understanding these agency rules is only step one. The real mastery comes from applying them to the tricky scenarios the exam throws at you, and that is where those free practice questions earn their keep. They are free, linked in the description, and built for this New York exam. Let us pull the domain together. We began with insurance as a transfer of risk, trading a small certain premium for relief from a large, uncertain loss, and sorted out the first, second, and third parties. Then we built the 5 terms: risk, exposure, hazard, peril, and loss, with pure versus speculative and moral versus morale. From there, we handled risk 5 ways through STARR, tested insurability with CANHAM, and saw how adverse selection threatens the pool, while underwriting and the law of large numbers protect it. We met reinsurance with its ceding and assuming parties, then toured the insurers, stock, mutual, fraternal, and the smaller forms. We finished with classification, domestic, foreign, and alien, admitted versus non-admitted, the rating agencies, and the distribution systems, before closing on agency, the 3 authorities, and the fiduciary duty. Notice how tightly it all interlocks. Homogeneity feeds the law of large numbers, apparent authority feeds estoppel, and the non-catastrophic element explains government coverage. Here is what I want you to carry into the exam room. This domain rewards precision, not memorized paragraphs, so drill the exact distinctions until naming them feels automatic. You know this material now. The next job is to prove it under realistic conditions. Be honest about which contrasts still feel shaky and hammer those. So before you head off, grab those free practice questions from the link in the description. With everything you learned today, plus real practice on questions written for this New York exam, you will walk in confident. Test yourself, find your weak spots, and close them one at a time. You have got this. Good luck. That wraps up our Property and Casualty Fundamentals review. If you'd like more questions to practice everything we just covered, head over to our website using the link in the description. There you'll find hundreds of free practice questions along with full study guides, all waiting for you to explore and work through at your own pace. Subscribe to catch the next part, and good luck on your exam.